Well, thank you everyone for joining us here for today's webinar, the topic of which being what to know about inheriting Australian assets in the US. I'm joined here today by Dylan Goldspring, an accomplished tax accountant and cross-border US Australian tax specialist, who will be running us through many of these details. So a little introduction before we get into things. You might like to note that all webinars are made available on YouTube, and we notify everyone who registers within about 24 hours after the webinar is up. So therefore, last month's webinar to do with Australian concepts for Australian taxation, of which there are a few references back to last month's webinar, that's up on YouTube. So please feel free to go there and subscribe. That really helps us out. It's worth mentioning, as I commonly do, when folks email me and ask questions, this does not constitute personal financial tax or investment advice. You are strongly recommended to get personal counsel for these matters. A little bit about me, maybe Dylan, you might like to just super quick highlights, and I can introduce you.
Very happily. So Ashley is a tri-citizen, born in the United Kingdom to an Australian dad, raised in Australia with an American mother, so quite a bit of exposure across the different states. Raised in Brisbane, studied an undergraduate in business management and IT, moved to the US as a corporate financial analyst from 06 to 09, completed his CFP and CFA studies in 2012, is a member of the Financial Planning Association, was the Next Gen Secretary in 13, and has also been an international and cross-border knowledge circle host from 2017 to date. He founded Arete Wealth Strategists in 2013, completed a graduate diploma in financial planning in 2018 in Australia, has previously been a professor at UC Berkeley and Golden Gate University, and regularly speaks at conferences with the Financial Planning Association and various other industry bodies, and is also the founder and executive director at the Global Financial Planning Institute.
Which is how Dylan and I met. So a little bit about Dylan. Is an Australian citizen. He's raised on the Gold Coast, lives on the Gold Coast. Still don't hold that against Dylan, as I often say. He attended Griffith University. He's just finishing up a PhD there, as a matter of fact, in international taxation, which is what has led to his real deepening of knowledge between Australia and the US. He's worked as a CFO for an international manufacturing company, so has experience in private practice and has a number of years, going on 5 years now, in public practice accounting. Okay, so with that being said, some of the issues that we assist our clients with, you can see here 3 client profiles. We've got the Australian business owner living in the US, an example of their goals and the results that we attain for them. The high net worth family currently living in the US, but looking to move overseas, and indeed they did. And we got a very, very good outcome for them, saving hundreds of thousands, if not millions, in taxes for them. Excuse me, and also the Australian executive family that has permanently relocated to the US, with whom I've been working with now for almost a decade, with very, very satisfying results there as well. Okay, so today's presentation is really focused on that bottom left quadrant that you see there, Australian property being inherited by a US beneficiary. Last month, we looked in the top left, that Australian property being inherited by an Australian beneficiary. But the reason we're stepping through this is because one presentation presupposes a little bit of knowledge from the former one. I'm excited also to go through estate planning, because not only will it ultimately be of relevance to all of us, but it's extremely complicated, and it's wonderful to be able to present this to the world and say this is how things happen when someone passes on. So let me outline what we're going to go through today. Really, this is Dylan's presentation for the most part, but to set things up, I'll be going through the differences in estate taxation between Australia and the US, talking at a very high philosophical level, US inheritance concepts, so that folks are aware of how things work there, which are drastically different to how they work in Australia. how the tax treaty changes a lot of things, and then Dylan will be going through. Really, we've structured this on an asset by asset basis. So before we get into stocks, investment portfolios, family trust, superannuation, life insurance, and real estate, Dylan will first be talking about some non-resident tax concepts, which didn't come up last month because obviously we're dealing with Australian tax residents inheriting Australian property. Okay, and this is further to what I mentioned a moment ago. It's talking about life insurance, primary residence, and investment property as well. So how does it all differ? So first, let's cover off on the differences in estate taxation. So technically, this is one of these things you might read in the news, particularly in the US, that say Australia doesn't have an estate tax. And that's true. But as we've seen with a whole number of these topics that we've looked at before, Australia taxes the same event, it just does it differently. It doesn't do it with an estate tax. It essentially uses the same gift tax rules that the US has. And the way things work when someone passes on a gift in the US is the taxable basis, that is how much gain would be assessed if that asset were ultimately sold, is determined by what the original grantor of the gift, the giftor, if you will, paid for that asset. So in Australia, it's the same thing. You inherit a stock portfolio, congratulations. If mom purchased that back in the 90s at a much lower basis, then that's now your basis. The US doesn't work like that. The US works with a step up in basis. So the most efficient way to, tax efficient, I should say, it's not efficient in many other regards, but the most tax efficient way to pass on an asset is at one's passing, because there's that step up in basis. Okay, income gift taxation is handled almost exclusively by the ATO, whereas in the US, you do bring in state level inheritance and estate taxation. So when we're talking about a US inheritance, we essentially have to carve that out of today's presentation, because with 50 states in the US and 50 different possible laws that may apply, we are only going to flag those states where there are an inheritance or estate tax to be aware of. Okay, so Australian inheritance concepts would, and Dylan will touch very briefly on some of these in his own slide on this, and then in greater detail on each of the individual asset classes. But essentially, the tax treatment intends on the nature of the asset, the timing of the transfer, and the nature of any payments while the estate is being distributed. And that is a nice flag to the residency status of the beneficiary. So Dylan, yet again, we'll be talking more about that. Australia, as you've all heard me say before, this is a very quick reference back to a key financial data sheet that we offer. We actually highlight the difference. This is in need of an update for the current financial year, but you can see in Australia, we really only have two tax statuses. We have the resident tax rate and the non-resident tax rate. And so that's where that distinction would come in that we saw right here. Okay, so federal estate tax concepts, US estate tax concepts, most of which are federal. There's a step up in basis to the fair market value at the date of death, which we've already been over. There's the federal estate and gift unified limit, which presently in 2022 is 12.06 million per individual. I will cover off on that one. That first one we can skip over. The third one, the 10-year stretch rule, did an entire webinar on that. That was to do with the Secure Act of 2019 and what that entails. And then lastly would be, we've got a graphic showing the state inheritance and estate taxes. So there's that fair market value example. That's the step up in basis to the fair market value at the date of death example that's given in the US. The estate tax and unified gift limit. This is one worth spending a moment on, and I apologize for how much text is on this slide, but this is a really important concept. So A US tax resident, that's any citizen, permanent resident, or anyone that's in the US and considered a tax resident by virtue of the substantial presence test, may make a gift to any other individual on an annual basis of up to $16,000. So that's very nice. There's no Form 709 required, a gift tax form required to be sent with that. It's just 16 to whatever number of beneficiaries. So between spouses, that's $32,000 that may be passed to their kids or anyone for that matter. If you want to gift above that, you absolutely can. That is going to eat in to your lifetime estate and gift tax limit. And so that's the use of that word there in the middle. The unified gift is you're able to pass on that amount of money during your life or at the end of your life, but that's it. Anything above that is going to be hit with 40%. And so that's what's described here, D, E, and F. So you've got this $12 million limit per person. It applies to gifts and estate taxes combined. Therefore, any amount over that, you're going to get hit at 40%. There is a good degree of estate planning strategies that can be employed, however, for those that have estates above that limit in order to manage that estate tax. That's a subject of a different webinar altogether. Okay, so the federal 10-year stretch rule for retirement accounts. This is currently being revised. I was at the AICPA conference in Las Vegas in June, and they were talking about this. A couple of revisions that are proposed is making it so that it's absolutely done by the 10th year, whereas now it can be stretched out to the 11th year, or shortening it down to 5 years altogether. This new law, it changed what was previously there, where it could previously be stretched over the lifespan of the inheritor. Now, by it being 10 years, it's typically going to result in a spiking of income taxes into higher brackets during the beneficiary's typically higher income in years. So much higher tax burden there with retirement accounts, particularly IRAs. And then what we have here, this is a graphic from the Tax Foundation showing us which states, it's color-coded as well, which states in the US have an estate tax or an inheritance tax. So the difference there, just to make it clear, what they sound the same, right? I mean, they're ultimately taxing death in one way or another. The estate tax taxes the entire estate of the deceased. So if it's going to one beneficiary or to 100 beneficiaries, it's the estate that is taxed. And inheritance tax, on the other hand, is focused on that individual. So therefore, the smaller number of beneficiaries and the greater the inheritance amount, the greater that estate tax would be. You have to worry if you're on the East Coast in certain states over here, Maryland in particular, where there's both an estate and inheritance tax. So they get you both ways there. The US and Australian estate tax treaty. Okay, so what do we have here? The US typically grants an estate tax exemption. We just saw this $12 million and $60,000 exemption. Well, that is for US tax residents, or specifically citizens, actually. That's for US citizens that get that full 12 million. If, however, you're an Aussie living in Australia with no ties to the US at all, and you happen to have US situs property, well, normally you would get a $60,000 exemption. Now we say normally because the next slide will somewhat undo this point here, but it is worth sticking with this just for a moment because it's one of those things, and I've spoken with many a tax attorney, many a tax and estate attorney on this topic, and US situs, what's deemed US situs, doesn't make a whole lot of sense. So there are some things that are, some things that aren't, and in fact, the same thing, depending on what account it's held in. I'm talking about cash. If it's held, the cash is held inside of a money market account, it's considered US situs, and if it's held in a bank account, it's considered not US situs. So like I said, doesn't make a whole lot of sense, but these are the rules. So what is US situs? Stock of US companies, real estate, of course, businesses with a tangible connection to the US, tangible personal property, what's that? Artwork, collectibles, etc. Private debt issued by corporations, that should be contrasted with publicly traded bonds. So that's not considered US situs for some reason. Cash value of a US life insurance policy, that requires definition. In my firm's fact finder, when we onboard a new client, we ask if you happen to have any cash value in a life insurance policy. I already know we don't ask that of Aussie residents. And the reason we don't ask that is because it's as rare as can be that you see cash value life insurance policies in Australia, because they went out in the 1980s. A cash value life insurance policy is an investment component tied in with a life insurance policy that you'll really only see in the US, and you don't see it that, or I don't see it that often. As Dylan kindly mentioned in the introduction, I used to be an instructor in risk management to up-and-coming certified financial planners, and my rule of thumb was a permanent life insurance policy, which is what holds cash value, is the last good place to go for an investment. So let's not say it's bad, it's just you got to have a pretty specific set of circumstances that apply to make that worthwhile. As you heard me say, money market funds are cash held at a brokerage firm. If it's in the brokerage account, US situs. If it's held in a bank account, not US situs. Annuities, qualified retirement plans. That's really of great relevance to us, that qualified retirement plan. So that is considered US situs. What's not US situs? US listed American depository receipts. This is a type of stock that you see in US brokerage accounts. We don't come across that all that often. Cash held in checking or savings accounts, stock of foreign companies, which is what an ADR is. Publicly traded bonds, which makes no sense, that we see over here, stock of US companies, but the bonds of the same companies are not considered US situs. So I have no idea why that would differ. Death benefit of a US life insurance policy, that's the part that's going to be most relevant to most individuals. And that's, if you go back to our do's and don'ts webinar, we recommend term and life insurance from the US, because as you're about to see, if you're the beneficiary of a life insurance policy held within superannuation in Australia and you're not a tax dependent, congratulations, you just paid the ATO a 15% tip, and you didn't need to. And you probably paid 30–40% more for the same dollar value of insurance. I have no idea why the US is so much cheaper for life insurance. It just is. So my recommendation there is really only for folks that need life insurance. We're a fee-only advisor, so we don't receive any commission, with no incentive to recommend that is not in our best interests for our clients. And then, of course, offshore mutual funds are not considered US situs either. Okay, so Australia and the US signed an estate tax treaty back in 1953. It serves two purposes, the first of which we don't really care about for today's presentation. I do want to acknowledge the source here, Renuka Summers from a Senior Advisors, and this great article she put together on that, where she's documented what comes from, or what is taxed where. The main takeaway is point number 2 here. And I'm just going to be quiet for a second so that you can soak that in. It extends the unified credit to Australian non-resident aliens. So what did we see just a few slides ago? $60,000. That sends a cold shiver through everybody who says, oh my goodness, I'm a non-resident alien and I own investment property or other US situs assets. Well, never fear, because Australia, being a trusty ally to the US in all its 20th century wars, congratulations, we get this exemption. So it's passed on to us as well, which greatly simplifies things for mixed nationality couples, of which I have a number of clients like that, where how things are treated between the husband, the spouses are somewhat simplified given the estate tax treaty. At this point, Dylan, I've done my lap around the track. I'm going to pass you the baton, and you keep running. And by the way, I just wanted to see if there were any questions, concerns, or doubtful points at this stage. We do want to make our presentations more interactive and conversational. So feel free to chime in with a question, and we'd be happy to do our best to answer that. All right, take it away, Dylan. No, nothing's coming in quite yet, but maybe something will.
No problem. So I think the first thing that we really need to define is sort of the bare concepts of an Australian non-resident beneficiary of a deceased estate. And to do that, we first need to define a deceased estate. So the operation of a deceased estate when someone passes in Australia is such that the assets and cash of that deceased individual will be put into a deceased estate trust. Now, the trust operates domestically in the same way that most other trusts will, whereby it has a trustee, but in this case will actually be the executor or the administrator of the estate itself. But for all intents and purposes for tax, they are still going to be essentially just the trustee. The will of the deceased and legal precedent will actually determine how the assets are transferred or whether or not they're sold within the trust. But whether or not they are actually directly transferred or sold within the trust is the really key difference in terms of the taxing point and how they're going to be taxed in Australia. When an asset passes to a non-resident beneficiary, which is something that we haven't covered yet, we have what's called capital gains tax event K3. And capital gains tax event K3 is essentially a deemed disposal when an asset is transferred by way of death to a non-resident beneficiary. Now, yes?
And Dylan, would you say that's the ATO's way of making sure that they get their piece no matter what? If it's going to a non-resident beneficiary, ATO is not going to miss out. And so there's this event K3 where there's a deemed disposal, even if there's no actual sale of that exactly. Asset.
Yeah, the ATO is looking at it in the sense that the asset is essentially now transferred offshore, not the asset itself, but the ownership and control of said asset is now without of their direct purview. So they're going to look at it and say, well, okay, this is a deemed disposal. The asset's been transferred out of our control. We want to tax it now because we could miss out later.
Okay.
Now, with how the actual deceased estate transfers assets, we need to first determine the types of assets that could be within the estate and also the types of mechanisms and ownership structure that could exist. And one very common one is obviously the Australian Family Trust. Now, the US tends to maintain a bit of a look-through view on Australian family trusts, but they're really quite commonly set up domestically because they provide the benefits that you're seeing on the screen there. They generally, if we're talking a discretionary trust, we have the ability to distribute income where we deem we want to distribute it. Obviously, the cash will also need to flow in that direction as well. They can perform or assist with a bit of estate planning simplicity in the sense that you can direct distributions from the trust within the trust deed itself, which is obviously an external mechanism to the estate. And generally, there can be a degree of creditor protection as well. Now, Australian family trusts, from a practical perspective, will typically own income-producing property, and that could be shares, real estate, or anything in between. Essentially, they're going to be making some kind of investment earnings generally. Next slide, if we could. So, from a US perspective, as I mentioned before, the Australian Family Trust generally receives a look-through treatment where the US is going to look at essentially the recipient of the distributions and also the controller of the trust, depending on the type of trust specifically. Now, because of the look-through treatment, we're not really even going to consider the Australian Family Trust in its own capacity, so much as we're going to consider the different asset classes that could be owned within the family trust, because their tax treatment is the really sort of integral point here. Now, the trustee can, as I mentioned before, dictate specific treatment on how the assets are sold or transferred, again, outside of the deceased estate itself. So it can provide a bit of a mechanism or definition on the passing of a trustee or an individual. So I think the easiest one to start with generally is going to be Australian stock portfolios, particularly because one, they're the most common, two, they're actually quite clearly defined. So if we could, Ash, the next slide. So when we have an Australian stock portfolio that's being transferred offshore, again, we're talking capital gains tax event K3. And recall that the deceased estate can do one of two things. It can sell the stock within the estate, or it can transfer the stock directly to the beneficiary. It's a really key difference, because if the stocks are actually sold within the estate, the tax is paid then and there by the estate, cash is transferred externally to that, there's no particular issue. But if we're transferring the stock overseas, we have K3 because the ATO loses that control. So, yes,
Dylan, I can't help but, and my brother Jeff will understand why I can't bite my tongue on this one, but I can't help but point this one out and just make sure everyone's clear about this. So, in other words, if you have an Australian estate that is to be settled and you have foreign beneficiaries, it is the easiest thing in the world to do, unless you mean to tip the ATO and leave them, a nice 5 or 6 or 7 figure gift on your departure out of this world. It is so easily avoided if you have the estate sell assets and then the non-resident beneficiaries assume the cash, as opposed to, and the reason for it is as simple as what we saw a moment ago with the Australian tax resident versus non-resident rates. If non-residents are inheriting this stuff, they're just going to pay a much higher rate of tax for the first $50,000 of income at least.
It can be quite detrimental, definitely. I think you do really need to seek advice in this sector when something like this is on the radar, because particularly when we're talking higher volumes or higher values, I should say, of asset holding, the implications can be really considerable, particularly because from a practical perspective, if you are receiving stock as a non-resident, you're not receiving cash, but you are going to have to pay tax. So we have a bit of a cash outlay as well, and a cash flow issue where you're going to be paying tax for something that you haven't received the proceeds for yet. So there's a couple of sharp areas in there that you really want to avoid. Yes.
Actually, this is such an important point that I did actually want to just go back, because I didn't make it in the way that I wanted to a moment ago. And that is to do with the other feature to do with how capital gains works in Australia. So let's say if a US tax resident was the beneficiary of $1 million stock portfolio with a $100,000 basis, so there's a $900,000 gain. In other words, if they're a non-resident, we need to be mindful that they don't get the CGT discount. So that's a $900,000 gain that is going to, for sure, because it's over 180,000, it's going to be taxed at a marginal rate, at the highest marginal rate, at 45%, compared with if it's sold within the Australian estate, we move over to this scale where there's the resident tax rate, where you do have a 50% CGT discount. Dylan, anything to add to that?
No, nothing particular to add. I think the difference speaks for itself, to be honest. The rates are quite punitive when we're talking a non-resident.
Right. Let me continue here.
So I think the next easy one to knock over is Australian life insurance. Again, particularly because, as Ashley explained before, we generally have a death benefit style life insurance on the Australian side of the fence. We typically don't have investment components or anything like that. So the second point there, where we're talking an investment gain on a cash value life insurance policy, is typically quite redundant and just not particularly relevant on the Australian side, because they just are few and far between. Now, generally, the death benefit itself will obviously be non-taxable in the US, because it's going to be received as a death benefit in the same way that you would receive a US death benefit. So if you did have a permanent policy with a cash value, though, you would generally be allowed foreign tax credits for any taxes paid on the Australian side. So the next main one that's particularly relevant for everyone, I find, is the primary residence or the main residence of a deceased individual. Now, we need to introduce at this point the concept of what's called taxable Australian property. So before running through the actual tax calculations of a primary residence and whether or not it is in fact a primary residence, The idea of taxable Australian property is again coming back to that CGT event K3, where the ATO is looking at the asset and saying, okay, do we have control over this asset? In the case of stocks, the assets transferred offshore, they lose a degree of control. Taxable Australian property generally extends to real estate in particular, and they maintain a degree of control over it because obviously it is still located in Australia. So in the event that an Australian real property is sold, they can still withhold on that sale. They have powers to be able to do that. Whereas if the stock is sold offshore, they have no ability to essentially bring that back into their fold. So in terms of the primary residence, you don't actually have this CGT event K3 or real estate in general. You don't have K3 because it will be classified as taxable Australian property. So the ATO is quite satisfied that they still have control over the impending sale. So you don't have a realization event in the same way that you do with stocks. Now, what is a primary residence? Really key definition. Generally, the primary residence cannot be used to produce income, and it needs to be the main residence for either the beneficiary, spouse of the deceased, or a person with a right to occupy under the will, obviously after the deceased passes away. If it continues to pass on to any of those individuals, it will essentially maintain its status as the main residence. Now, on this side, if the main residence was to start earning investment earnings after the deceased passed away, the investment income is obviously going to be taxable in the US. We're going to have a step up in basis for when that asset was first inherited. So the property is inherited. So the US will give us that step up in basis. And the impending capital gain on sale when that property is sold is obviously going to be taxable in both jurisdictions because we now have an income producing property, but we will generally be allowed tax credits for any of the Australian taxes paid. Okay. So again, this is really going to cover off on taxable Australian property. We get the step up in basis. The issue that we have on the US side and also on the Australian side is, say, for instance, this property is sold 5 years down the line after the deceased passed away and after the inheritance event occurred. If you as a non-resident sell this asset after it's been income producing for 5 years, you are going to have a capital gain at non-resident tax rates, and you're also going to have 5 years worth of investment earnings at non-resident tax rates. So you really need to understand, I think, what the overall goal is here. Like, are we actually going to want to essentially accrue some significant capital gain, receive no capital gains tax discount, and pay a minimum of 32% all the way up to probably 47% on an asset that's sitting over in Australia? You probably really need to consider your individual situation and goals if that's going to be something that we want to do. So here's a bit of a flow chart, which we actually introduced in the previous webinar, where we're going to run through, I think, the main residence and capital gains tax exemption based on certain conditions. Now, capital gains tax was introduced in Australia on the 20th of September 1985. So generally, any assets that were acquired before that date actually are capital gains tax exempt up to a certain point. So the perfect example is actually that an individual bought their main residence in, say, 1980, before the introduction of capital gains tax. They sold the asset last year in 2021. In that instance, we have a balancing date in 2021 on their date of death. Now, on the date of death, if the property wasn't income producing, it depends on what it's going to do moving forward. Essentially, at the date of death, we're going to say, okay, fair market value of the property, that's going to be the cost base for both the Australian side and the US side, because we essentially have circumvented capital gains tax because of the acquisition. There was never an acquisition date up until that point. Now, whether or not the property is being used to produce income at any point in time prior to that is going to be really relevant for properties acquired after 1985. And whether or not the property was disposed of within 2 years is actually less relevant now, because I believe they're looking at passing, if not already, a rule where if you are a non-resident that's inherited a property from an Australian beneficiary, you actually might not have this 2-year window to dispose of the property before a taxable event occurs. they're still going to look at the fair market value date on the date of death. So a couple of really important sections in this area, but as you can see in the chart, it is particularly complicated and there are a lot of steps in the classification.
Dylan, can you say that one again about the non-residents and their forfeiture of the 2-year window?
So generally, with the 2-year window, if you're a resident beneficiary of a main residence, say, you have a 2-year window where you can dispose of that residence before we have any capital gains tax on any additional gain that occurs within the 2 years.
Yeah.
If you're a non-resident, however, there was legislation that they were looking to introduce back in about 2017-18, where they were going to remove that 2-year window for non-resident beneficiaries. So it's something that really needs to be assessed on a case-by-case basis, but there's a lot of red flags, and realistically, every single one of these points here is vital in assessing it on a case-by-case basis. Now, investment property, we have the same concept with taxable Australian property. It will apply to investment properties as well, because again, we're talking real property. However, we're going to have some kind of capital gains tax event generally, or we're going to have a high proportion of capital gains tax applied to the property because it was income producing. So we're not going to qualify for a main residence exemption for any period prior to the deceased's passing. So next slide, sorry, Ash. Okay, again, K3 does not apply because it is taxable Australian property. CGT event K3 will not apply. Now, unlike the main, yep.
And just to clarify there, to de-jargonize what you're saying, K3 is the deemed disposition, disposition, meaning the ATO would treat it as if it is sold, whether it in fact is sold or not. You're saying that does not apply because you can't exactly pick up your investment property from Australia and move it to the US. So the ATO is always going to get their bite.
Exactly right, and quite well said, actually. So I think when K3 doesn't apply, and let's just say it's the ATO's control, we have no immediate taxable event on the transfer, but we do have a cost basis adjustment or a cost basis calculation to do. Now, unlike the main residence, we're not going to get that same step up in basis to the fair market value on the date of death. However, essentially, if the property was income producing, we're going to inherit whoever the deceased or whatever the deceased cost base was when they first acquired the property. And that's a really, really key point, because if we have a property that's $600,000 today, but it was acquired for $300,000 10 years ago, if it's a main residence, your inherited cost base is $600,000. If it's an investment property, your inherited cost base is $300,000. Now, the difference there is massive, particularly when we're talking non-resident tax rates for one, and two, no capital gains tax discount. So we're exposed to essentially $300,000 worth of capital gains tax income at quite punitive rates. So realistically, at that point in time, if we are going to inherit properties like that and no estate planning's been done prior to this point, you really have a key decision to make as to whether or not you want to maintain that structure moving forward. Now, US taxes will apply generally on the gain on the sale. However, foreign tax credits will generally be available for Australian taxes paid. And thankfully, generally, the Australian taxes will be over and above what the US will charge, depending on the situation. So,
only an accountant would say that. Thankfully, the taxes are higher in Australia. So
I have to sell myself as something, my goodness.
But
sometimes
you're not going to get double taxed is the bottom line there. So the tax you paid in Australia is going to offset what you would have otherwise had to pay in the US.
Correct. Thankfully, we're not in such a regime where we don't expose ourselves to double tax, but we can expose ourselves to punitive rates, and that's essentially what we want to avoid with the planning. So,
right. Well said.
Now, with Australian superannuation, this is a really complicated topic, so we're going to spend a bit of time on itemizing a few key definitions step by step. So, with this first slide here, For any foreign inheritance, the asset being inherited is the first vital definition. Are we taking cash? Are we taking stocks? Is it a distribution from an estate trust? What exactly are we talking? Now, in the case with superannuation, they're a little bit of a unicorn in the Australian sense because they are treated very, very differently, both on passing of an individual and also just in the general day-to-day. Now, what we have within superannuation are a couple of different components. The components I can run into a degree of depth, but it's probably outside of the scope of this presentation. But the build-up is generally that we have a tax-free component and then a taxable component. Within the taxable component, we have the taxed element and the untaxed element. Now, when a distribution is made from a superannuation fund, there's essentially a ratio or a breakdown within the fund of how much is the tax-free component, how much is the taxable taxed, and the untaxed taxable. The tax treatment for the distribution depends entirely on the component itself. So you're going to receive a pro rata component of each of those three elements, and the tax treatment will depend on each of the elements themselves. And the key definition here is whether or not you're in fact a tax dependent, because there's certain concessions within those three elements for whether or not you're a tax dependent for that superannuation member. So if it was a direct parent, for instance.
Dylan, would it help to say that for most private sector workers, unless they have made non-concessional contributions, which is what I see, you know, in terms of the clients that I see, most of them have simply received the what is now 10.5% superannuation guarantee from their employers. That's almost 100% of what constitutes their account. If that is your instance, then you're looking at a taxable taxed component. Is that correct?
Correct, yeah. The taxable untaxed component has generally only been for public service, generally. Yeah. So there's certain contributions that can be not taxed within the fund on the way in. And obviously when you reach preservation age and older age, you can withdraw from that and not be exposed to higher taxes, but it's generally limited to the public service, yes.
And the tax-free, that's going to be your non-concessionals, your non-concessional contributions. So in other words, your post-tax contributions, if you were to have made any at all.
Exactly right. Yeah. If you're putting money into superannuation that you individually have already paid tax on, we're talking a non-concessional contribution. And again, because of double taxation, the fund's not going to look at taxing that again.
Okay.
So with the definition of a tax dependent, generally we're talking immediate family, particularly a spouse or de facto. Interestingly, a former spouse or de facto as well, so long as there's a degree of financial dependency there. A child under 18 years and a person that's in an interdependent relationship with the individual, which is generally going to be a legally defined term and again assessed on a case-by-case basis. Now, what you can receive as a tax dependent can be either an income stream and or a lump sum, whereas a non-dependent can only receive a lump sum. So on the payout of that superannuation account, a non-tax dependent can only receive a lump sum once, but a tax dependent can actually receive an income stream generally up until the age of 25 before it needs to be paid out as a lump sum. The next slide, please. So here, again, just to cover off on the types of payments, lump sum benefits paid to a tax dependent will generally be tax-free domestically, so in Australia only. Lump sum death benefits paid to a non-dependent will have a breakup of components based on, again, what those components are made of, which the fund keeps a record of, and that's going to be assessed based on the proportioning rule. So again, you're going to receive a pro rata payout of each of the components within those funds, which is relevant particularly if you're a non-tax dependent. The next slide, please.
Sorry, just one thing I thought I'd say there, and this is where I feel I can add value in the presentation, is just outlining what the treatment is going to be from most individuals. So if you're talking about, again, most private sector workers who have largely got was it a taxed, let's go back there, a taxable taxed component. If you are a tax dependent, which we just saw here, then it comes to you tax-free. If you're not a tax dependent, then it's going to be taxed, and I believe it's a 15% withholding on that distribution.
Yes.
That's paid out. Okay, thank you.
So again, if we're looking back at the concept of the deceased estate trust, it's generally going to accumulate all of the assets owned by the deceased and then distribute it according to the will, subject to any intermediary structures in place, like an Australian family trust, which might circumvent certain things there. Again, to highlight, superannuation payments are dealt with independently. And as Ashley just mentioned then, payments to a non-resident or a non-tax dependent realistically are going to attract a 15% withholding rate. Now, on the Australian tax resident side of things, that 15% withholding will get entered into their Australian tax return, and the income that they've received from the taxable tax component will form their assessable income, and then they'll have their reconciliation event in the same way that they do their tax return every year. Now, as a non-resident, you're not required to lodge an Australian tax return. So that 15% withholding is essentially a final tax. As much as it is called withholding, it is a final tax. It's locked away. You don't do a tax return, so there's no clawback there. Now, the tax withholding is going to get paid directly to the ATO on the taxable components only. The tax-free components will generally not be subject to Australian taxes. Now, for the definition and how it's going to play out in the United States, we need to first classify what a superannuation account is under US law, which ironically there is already a webinar on YouTube, which goes into that in a good degree of detail as well. And
not a random webinar on YouTube that, you know, someone this is one that we did about 4 years ago.
Yeah, correct. So without getting into the really nitty-gritty detail here, because this is a really complicated area, the US generally will not see any retirement plan as a non-US retirement plan as a qualified plan. Whether or not there's a tax treaty involved and whether that provides any direction on deductibility of contributions or distributions is a whole different area. But essentially what we have is either a non-exempt employee benefits trust, so a 402B, or a foreign grantor trust in terms of what we're looking at for a superannuation account. And again, both non-qualified plan, we're not talking essentially any US retirement equivalent here. We're getting superannuation classified into one of the two buckets of 402B or a foreign grantor trust. So with that, essentially, we're going to have tax treatment on the US as a distribution from a trust. And a distribution from any trust is going to consist of a couple of different elements, and one being the corpus, so the original contributions to the trust, which essentially is just going to be a return of cash that has already been put into the trust, and then the earnings component, so what that corpus actually earned over the course of its lifetime. So if you put 100,000 into a trust and it earns 50,000, we have 100,000 worth of corpus and 50,000 worth of earnings within the trust. Now, based on that, if you were to receive that 150,000 as a distribution on the US side, we have 50,000 worth of assessable earnings and 100,000 worth of corpus distribution. And we also have a foreign tax credit from the Australian taxes paid when you receive that superannuation distribution in the first place, being 15% on the taxable components. So two really key points. We have 15% taxes paid to the ATO on the distribution of the taxable component, but then we essentially need to determine what the earned amount within the superannuation fund is prorated to your distribution to determine how much of that distribution is going to be assessable earnings in the US.
I think if I could clarify that, I could say the inheritance of a super account is probably one of the less efficient assets that one could inherit in the US. I think that seems safe to say. I mean, of course, depends on the composition of the super account, but mostly you're going to see individuals with a taxable element. to non-tax dependents. That's going to be the vast majority of the instances that we're going to see. And if that's the case, then not only do you have the 15% withholding on the Australian side, but then you've got to determine the basis that the IRS would have in that account, and then the whole thing is distributed and get taxed at ordinary income rates, and it's just not pretty.
It's a bit messy, and I think that another key difference on the Australian side here is that there's very few situations where the Australian tax rate is going to be lower than the US tax rate, and this is actually one of them, because we have a distribution from an account that only on the taxable component is going to pay 15%. But on the US side, we're looking at the earnings of the entire thing, and we're going to put them at individual rates. That could actually result in a bit of a shortfall to pay on the US side, notwithstanding the credit.
Well, that's what I was thinking, Dylan, was for sure most people, unless they're in a zero income bracket with a very small super account that they're inheriting, most people will have a subsequent US tax bill on top of the 15% withholding.
Yep, exactly right. And that is the risk that we run when inheriting the superannuation account.
Okay, it does make me wonder if, late stage individuals, I mean, who really knows when they're going to meet their maker, but if they're being smart about their estate planning and they've got US beneficiaries, what might it suggest about moving assets out of super?
Mm-hmm. And again, that also depends entirely on the age of the individual as well. I mean, if we're talking moving assets out of super, we need to be at the very least 60 plus generally, because as much as the US will, on a retirement account, penalize an early withdrawal, it's not even possible on the Australian side. So you're quite limited with your option, but you really do generally need to seek advice in that area if you have exposure, because it is incredibly complicated.
Is there an exemption to withdrawing from super with a terminal illness, though?
There is, yeah. So if you do have a terminal illness or you're permanently incapacitated, you generally are able to withdraw. The tax on that withdrawal will depend on the situation entirely, and also the components within the fund, but it is a viable means. So if you are unfortunately terminal and looking down the barrel of a couple of years, you do have a bit of time to plan. And you do probably need to seek advice quite quickly. Yeah,
okay. Well, thank you, Dylan. Appreciate that. If anyone would like to reach out and talk to me, this is the way they do it. Come to arete-wa.com, go over to the Get Started area there. You can access that key financial data sheet that I referred to earlier just by going to the website. It's right there in the Knowledge Center of Key Financial Data. And I want to open the floor up, but before I do that, to questions. Dylan, how would folks best get in contact? I mean, your email address is right there, but any other recommendations on how folks might best get in contact with you, or perhaps a description of the kind of client you do your best work with?
Look, realistically, I'd like to hope that I do my best work with many. So I'm happy to help anyone realistically. I think the best way to get in contact outside of email is if you go directly to the website, cdgcorporate.com. There is actually a link there where you're able to book an initial consultation where we can have a quick chat for 15 minutes free of charge, just to essentially assess your situation and get a bit of an idea on what we're looking at.
Okay. Well, I'm really happy with how that went, Dylan. I thank you very much for your time. I think that demystified a lot of what happens across borders there. Maybe it matters a little less what I think and more what the folks on the call here think. Any questions, concerns, doubtful points, anything you're hoping we might clarify just in our final few minutes here together today? And just while folks are formulating those questions, I see one has come in. I did want to mention, Dylan and I are rounding out Q3 of 2022 next month with case studies. So we're hoping to further illustrate this. A lot of last month's and this month's presentation has just been whacking you with examples of the tax treatment by different asset classes and how the different countries tax. Whereas in the next presentation, we're hoping to give some more complex examples of saying, okay, we have a US person, Australian beneficiary, how does that work? Vice versa. Now we've got kids in multiple countries, how does that work? and really trying to come up with some good complex examples. So question here from Andrew, will a dual US Australian citizen be able to claim the $12 million exemption on the passing of elderly parents? Well, that's a fine question, Andrew, because I think what you're saying is if the beneficiary is a dual Australian US citizen, there's no mention there of the parents' status. Are they Aussies only, or what's their deal? Maybe it doesn't matter. I mean, we could clarify that. It doesn't matter anyway. The answer would be it wouldn't come into it because it's not a gift. If I'm understanding it correctly, the parents are Aussies only. The beneficiaries, yes, beneficiary meaning the US parents, Australian citizens. It's not going to come into it because it's not only is it not a gift you're making, it's not an estate that you're distributing, i.e., because you're not passing on. So actually, this is a very, very, very common question. A lot of hand wringing that goes into it, but in this case, on the US side, there would really be only a form 3520. What is it? A foreign gift form is what the 3520 is that would be required for that, just to notify that this has been received and there would not be any tax, US tax due in that instance. However, review today's presentation to figure out what Australian tax might be payable and what bugs you might be able to put in ears to be able to make better use of that. But of course, ultimately, it's your parents' decision what they're going to do. It's just, do they want to leave a tip to the IRS or not? Okay, or to the ATO or not. Jan writes, what if you want to split time 50-50 in Australia and the US? Does this make it especially difficult? It does in many other ways, not difficult necessarily, but more complicated. In this case, because of the estate tax treaty, it really doesn't make much of a difference. Perhaps I would fine-tune my answer by saying it would depend if you are looking at having an estate above that estate tax limit of 12 million and you are only an Aussie, then the question I would have for you would be, where are your assets sightest? And I'll go back to that slide earlier where I talk about that, because that would be the distinguishing feature. Dylan, do you have anything to add to that one?
I would actually say that I think your main definition here is that Australia operates on obviously a residency-based model. So as much as the time spent 50-50 between the two areas, whether or not you're actually exposed as an Australian tax resident or a non-resident depends on the statutory tests within Australia. And I think that you're also talking a balancing date for when the passing actually happens, when this individual passes, because are you an Australian tax resident at the point that the individual passes, or are you just going to be a US resident? And then we're talking potentially a tiebreaker provision under the treaty as to which is your primary residence as well. So it does make it complicated, but I'd say that a bit of planning probably needs to be done in that space to determine, what your primary residence actually is.
Well, and I would go one step further and say this is where the definition of domicile comes in, and that is, the countries will look to see where you consider your permanent place of residence to be. It's a finer point, actually. It sounds like the same thing as what Dale's saying, but it's not. It means, where do you truly see yourself as living out the rest of your life? And you actually just never see it. I don't believe it could exist in reality, that it truly is 50-50. I mean, it's almost impossible. I mean, you're talking about spending 183 days one year in one country, 183 days in the next. It just wouldn't actually happen. So there is a facts and circumstances test to determine domicile, but in this case, I don't think it really matters that much because of the estate tax treaty, and not too many folks are likely to hit that 12 million. It is worth mentioning, before I move on to Paul's question here, that in 2025, that estate tax exemption is scheduled to sunset and move down to 5.5 million per individual. So more than a halving, but still, if we go back a dozen years, it's still where it was 2 million, it's still quite substantially higher than what it was formerly. Paul Vella. Hi, Paul. If the US beneficiary, who is a permanent resident, receives only a cash benefit from the estate of an Australian, is it taxable in the US? And if so, what tax rate? It's not taxable in the US. Simple. It is not taxable in the US. And that's the key, and I'm extremely confident of that answer. I've had that one 100 times before, and I've approached it from every vector and angle you can think of. But if it's as simple as what you described, they just, the estate has settled. Here's 200,000 in cash. That's it. The US is quite happy to have more money come into it so that it can ultimately tax it on whatever that money is put to work doing. I think that's a wrap. There's been no more questions. You're welcome, Paul. Thank you very much. And remember, next month, we're looking at case studies. So we're tying all of this together. If this has been a little bit academic for you, then next month is going to be more practical, because we can actually say, if you've got this family structure and this inheritance, blah, 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 this is how it's likely to work out. I hope you can join us, and thank you so much. Have a wonderful rest of your day. Thank you, Dylan.